What's up, everybody? It's the Digital World Podcast. Folks, we're still at 4.72. If, and not only if, I should say when, they run deficits even higher and and they try to grow themselves out of this mess, I think you're gonna see that the long end of the yield curves will go higher. They A lot of things that are done by the Fed, right, and the uh, Treasury are to try to manipulate the short end because that's all they can do. But when you start running deficits higher and try to grow your way out of um, debt, so essentially inflate away, um, what you're going to see is these long end yields are going to rise. And right now, it's been stabilized and it's been in this, tightening wedge the past, 2 years, 2.5 years. And so when this breaks out and goes higher, right? When your yield on a bond goes higher, you're essentially demand for those bonds are coming down. I mean, it could be a variety of reasons, but essentially the face value of the bond is less and the yield is higher, right? To attract investors, uh, and some of those things can signal weakness, underlying weakness, and potential loss of confidence, right? Or it could be some of these nations, right, are in a higher crisis mode than we are, and they're selling their bonds in order to repay their debts that are due in dollars. And so it's like a perfect storm. It's not just one thing. There's multiple variables at play, and that's what I think is. If you haven't checked out the milkshake theory, highly recommend. And also Triffin's dilemma. Now, what does that mean for houses? I've made a video recently that's showing how right now the data is showing that there is a very, that's what do you call, pro-cyclical, if you will, environment. And I'll show you a post right now talking about this. And right now rates are, what rates are. I would say that long term I think these are going higher. I don't think they're coming down. That doesn't mean I'm 100% correct, but if we're looking at the trend for these yields here, I think it's a safe bet to say, right? Nothing's absolute, but there's a high probability that these will continue to go higher. Now, I want you to see this. Both fiscal and monetary policy have turned pro-cyclical, feeding the same direction of the cycle rather than stabilizing. So we're cutting rates into already high markets, right? All-time highs. Real rates are falling on the left. So you see real rates are slowly coming down, if you can see that, right? And as net government outlays are increasing, so expenditures, right, going up. Think about what this does. We have cheaper money for the private sector to borrow, right? And more money from the public sector that's going into the private sector. All of this is creating a net increase for GDP to run above 3% real, which is massively bullish. So if this is the case, and this is the environment we're headed into, very possible that you can see housing get more expensive. There's a probability there. This also could indicate that markets have one leg higher to go. Housing, it's a little slower, it's a lagging indicator, but we see home builder sentiment, right? bounce off the lows in April. So we'll have to continue monitoring the situation, but you always got to weigh all possibilities. I think in the long term, right? Long term perspective, it's not looking good. In the short term, there could be a run up that will eventually lead to the inevitable crash. But things aren't getting easier; they're getting harder. So, that in mind, thank you for watching. Like and subscribe to the channel. It's the Digital World Podcast, and I'll see you in the next episode.